If you follow the commodities markets, you're likely well aware of all the headlines highlighting the record price of gold. That's not the only precious metal on the rise. Silver also been enjoying quite a run, especially as the metal deals with historically low inventories. Here to take us through the metals complex is Daniel Galley, Senior Commodity Strategist at TD Securities. Daniel, great to have you back on the program.
Yeah, it's great to see you, Greg.
Right, I read your notes all the time. You talk about the silver squeeze. One of the hot topics right now is vault depletion for not only silver, for the PGMs, the platinum metal groups. What's going on here?
Yeah, you know, it's really interesting. And let me start off by saying, in the case of silver, this has been it's been a long time coming, right? We are now 5 years into a structural deficit. That structural deficit has been depleting above ground inventories. The fact of the matter is, there was going to come a point in time where London, which is the world's primary venue for over-the-counter trading and where most of the physical metal would be stored against that over-the-counter trading activity, those vaults will have had come under pressure over time as a result of the structural deficit alone. The thing is, the threat of tariffs, whether that be reciprocal tariffs earlier this year or still the threat that exists today, which is around Section 232 investigation for critical minerals, which silver is a part of, that has accelerated the drain of inventories out of London as traders have been incentivized to move that metal from London into the United States. And I brought a really great chart to highlight, which basically just shows the extent to which the metal that is actually freely available for purchase sitting in London today has depleted. It's now depleted well below what we think are critical thresholds for the market structure. And the consequence is that the silver market is actually getting less and less liquid as prices are rising. I'd even point to the fact that the implication here is that prices have to rally in order to incentivize metal to come in from unconventional sources. Right.
Well, an unconventional source, what would that be? I mean, because when you put silver into something and it's no longer have a useful life in that product, I assume we can take the silver back, right?
Yeah. You know, that's the interesting thing. When you think about precious metals, nobody actually throws out their gold or throws out their silver. So in some sense, every ounce of gold or silver that has ever been mined in human history is sitting in some form somewhere. And the question is, at what price will that silver come back to the market? So the unconventional sources that I'm really talking about here, the most prevalent ones are probably private vault holdings. So these would be family offices that hold a lot of precious metals in their own vaults. There is a price at which they might be induced to sell. And if they were to do that, then that metal would be coming back to the market. But the interesting thing is, as when we started talking about this more than a year ago, people expected that, you know, at $40, that metal will come back. Now it's, well, maybe that's 45, maybe it's 50, maybe
we
it's
haven't found the price yet to get people to open their vaults.
That's right. That's what an analyst like myself would call a price discovery process. The market is pushing until it finds what is that strike price at which that metal will come back.
All right, you have another chart that you brought with us. Let's take a look at this picture and explain to us what it's telling us.
Yeah, well, this is explaining the sense of urgency around the situation, right? Not only has that free-floating stockpile of inventory depleted so much, but we also happen to be in a cutting cycle. And the average pace of ETF inflows in a cutting cycle, at that pace, that free-floating stockpile of silver would be completely depleted within 4 months. So this is really the end stage of what we envisioned. Things are going to get faster from this moment on because really the market's running out of time. If inflows continue at the current pace, they're drawing down the free float as ETFs are securing that metal for their own purposes.
Oh, so those three lines at the end of the chart there, they're showing us the low, mean, and high estimates. Now that we're in a cutting cycle, the probable outcomes of that cutting
right.
cycle. Yeah.
And really what I want to point to is the red line there, which is the ceiling at which you're actually at a depletion of the free float. So the timeline we're talking around here is really short, 4 months until you reach depletion, and that's not even considering the fact that demand elsewhere in the world is also strong for other reasons, right? Indian demand for silver is also draining the free float further.
So if we're not found the price yet for people to open their vaults, have we found the price for miners to go looking for more silver?
Well, that's really interesting. The thing is, I think it is really rare to have a pure play silver mine. So in terms of discoveries out there, and even more broadly, silver is primarily mined as a byproduct of other metals. So somebody who is mining zinc, for example, might have some silver as a byproduct, and that's what forms this global silver market supply, or on the supply side. So are we at the strike price at which that could occur? We might be, but the timelines to build a new mine are just so long, and we've spoken about this many times, that this just can't be the source of solving this. You can only solve this imbalance in one of two ways. Prices rally until they find the strike price to bring metal in from unconventional sources, or demand declines sufficiently to solve the imbalance in the other way.
Right, so those are the two scenarios. How do you see it playing out from here?
We think, given the short timelines ahead, this is a moment in time where prices can gap. Liquidity is so constrained that we could see the price reaction function be increasingly convex, meaning that the price of silver will rally in a faster and faster fashion as that free float is drained further.
If that ends up being the case and you do reach a price where someone want to open their private vaults, how quickly could the price then turn around?
That could also be a pretty fast turnaround, right? And this is really the key here, is that going to happen gradually, or is it going to come all at once? I think the reality is, what we've seen from other markets in similar situations in the past, is this actually tends to be a more gradual development, but there does come a point in time where there is enough and there's a flood of metal that comes back to the market, which is at least sufficient enough to solve the problem or the imbalance for a certain period of time.